here with the Illinois Student Assistance Commission. Today is our final webinar of our income-driven repayment webinar series, the countdown to April 30th, how to benefit from the federal student loan debt relief. Before we begin, just want to go through a couple of housekeeping items. Want to mention that this session is being recorded and it will be shared on our PD page on the portion of our website on demand webinars. Give us about a week or two to get those recordings posted, and then you can go ahead and visit that site to view them. If for whatever reason you or any of your colleagues are having issues with audio, you can always use the call me option on the bottom right-hand portion of your screen. There you can dial in the number on your phone and get audio that way. Also, feel free to ask questions throughout the webinar. I have a variety of colleagues on the line who will be able to answer your questions throughout the webinar. Just use the Q&A feature. Again, bottom right-hand corner of your screen. Please post your questions there. It helps us keep it as much as organized as we can. And we will also not be offering continuing education and professional development hours. However, we will still post an evaluation just so we can receive your feedback for today's session, but CE and PD hours will not be offered. So we'd like to have the slide up here in case there's folks joining us for the first time and maybe are not aware about who we are as an agency. Our mission is to provide Illinois students with information and assistance to help make education beyond high school, whatever that might be, more accessible and affordable. We also administer a variety of scholarships and grants across our state, whether that be a grant for exonerees, veterans grants, National Guard, Teachers Illinois Scholarship for minority students, special education waivers. You name it, we have a ton of scholarships and grants that we administer here at the agency. And then for myself and the colleagues on the line here today, the professional development side, we offer tons of support regarding sessions on the financial aid process, FAFSA simplification, resources for our underrepresented students, as well as sessions like today about understanding the student loan process, IDRs, repayment forgiveness options, etc. So here is our agenda for this afternoon. I'm going to just briefly go through what those income-driven repayment plans are and some of the differences between them. And then we'll talk about the account adjustment overview, and then I'll go ahead and dive into some of the impacts that it also has on public service loan forgiveness and consolidating. And then we'll go through some frequently asked questions and then some general resources for all of us to be aware of. Okay, let's go ahead and dive into those IDR plans. So IDR stands for income-driven repayment plans, and these plans will set the payment amount that is intended to be affordable to you as a borrower based upon your income and your family size. By the end of the repayment period, whether that's 10, 20, 25 years, any remaining balance that you still have on your loans is to then be forgiven. So the IDR term is sort of an umbrella term that's describing multiple plans here, right? First, we have pay as you earn. The next, we have the SAVE plan, which is Saving on a Valuable Education Plan. This is a brand new plan just implemented by the Biden administration, and it replaces formerly known as the Revised Pay as You Earn plan, or REPAY. So if you had REPAY, you're now on SAVE. Everyone can apply for SAVE if they'd like to. There's different options available. And then they have income-based repayment, the IVR plan, and then the income contingent repayment, ICR. Again, you have to apply for these repayment plans if you're interested. And there are different ways that you can kind of compare and contrast to see which out of these four plans would be best cost effective for you as a borrower. Again, they do base that on your income and your family size. So let's get into more details here about some of the comparisons. You want to consider a couple of questions when you're looking through these. And I always turn folks to the studentaid.gov website. Manage loan section of that page gives you the full details of the IDR plans and a variety of other types of plans, whether it's just the standard plan, the graduated plan, the extended plan. Again, kind of all a one-stop shop to do a best sort of comparing analysis. And I'll also show you a little bit later about the Federal Student Aid Estimator tool. I often turn folks there when they're kind of considering, hey, what plan should I even choose in the first place? It can kind of help you put some estimates in there so that you can make an informed decision. But again, you want to consider which are these plans that you're going to be eligible for, right? A lot of times, for the income-driven repayment plans, again, it's designed for you to have a lower, hopefully, monthly payment so that there's a balance at the end actually be forgiven. For some of our higher income folks, maybe that won't make sense for everyone, right? Because, they may pay their loans off a lot faster, and some folks may not choose to do that. You also want to consider whether to consolidate your loans. We'll talk a little bit about consolidation today and how that's going to maybe affect a potential forgiveness plan or this IDR adjustment. And then what are your repayment terms? So you can see here on a screenshot on the right-hand portion of your screen, some of the different types of details in specifically with the plans here. So the SAVE plan being 10% of discretionary income, and it talks about how long you would repay that for. Undergraduate loans would be 20 years, and any graduate loans would be 25 years. You can see here the different percentages of discretionary income for each of the 4 plans, and then the amount of time that they will have you paying off those loans before any sort of balance left over would be forgiven. Now, with the repayment plans, it's important you're going to be required to update income and family size on a yearly basis, right? So they're going to either manually or just provide now consent for the IRS to transfer tax information over, which will then count for their annual recertification of their income and household size. Now, those folks who choose to manually enter information will likely need to upload some supporting documentation as part of their application, as well as the recertification process. Again, just to verify that those numbers you're manually reporting are, of course, accurate. I will say it is just much easier to just kind of hit consent and allow the direct data exchange to take place. It's information the IRS has already. You're just giving consent to have that transferred over to the Department of Ed for student loan purposes. Now, you as a borrower can change your IDR plans or ask for a recalculation if there's a significant change in maybe your income or maybe your family size at any time. Even though it's required on an annual basis, we know life happens, right? You may be 6 months into your recertification period and you may have a sudden, death in the family, unfortunately, or, there may be a divorce or some kind of extenuating special circumstance that leads to you as a borrower having a significant change in income or family size. You can go ahead and update that information with the Department of Ed and your loan servicer to allow that recalculation of your IDR monthly payment to happen. They may ask for additional documentation, to verify, okay, what is this special circumstance you're talking about here before they kind of approve it. But nevertheless, you have the ability to do so at any time. You don't have to wait until that once a year period. Talk a little bit now about consolidation. Consolidation is essentially combining all of your sort of separate loans into one simple loan with one monthly payment, one fixed interest rate, and one lender. I chose to do this after I graduated and completed my grace period. It just was simpler for me to understand things before I even understood different forgiveness plans and such. Having 4 separate loans and paying those off at 4 separate times was confusing to me. So having one lender and one payment with one interest rate made things simpler for me in my brain. But to do so, you have to apply, and that link is there in the Managed Loan section of the studentaid.gov website. Once you apply and you consolidation of those loans are complete, it can't be reversed. Now, you are given a 10-day sort of, I think, a little bit of cancellation period after you receive your summary statement. So you kind of get a 10-day window there. But after that, it's final and permanent, and there's no way to reverse it. Some cons to maybe consolidating that we like to mention is about losing access to some of your maybe perhaps lower interest rates. Say you have loans over a 4-year period. Perhaps your freshman year loans have a lower interest rate than, say, your senior year loans. Well, when you consolidate, they're going to take an average of all of the interest rates you have in your loans, giving you your one fixed interest rate. Obviously, a couple of the loans that have the lower interest rates, you lose access to those. Full details on consolidation we have linked there on the studentaid.gov site. Feel free to check that out at your disposal. Okay, let's go ahead now and dive into the account adjustment overview. This kind of goes back, we're reversing here a couple of years ago, back in April 2022, when the Department of Ed announced some specific steps that would bring borrowers closer to forgiveness by updating their payment accounts on their IDR plans. So this adjustment was intended to make the payment counts of borrowers more accurately reflect their situations. And the adjustments have been currently underway for a while now. They are going to do so until July 1 of 2024. Now, borrowers are eligible for this adjustment regardless of whether they are currently enrolled in an income-driven repayment plan or not. I think through their research over the course of the years, the Department of Ed has figured out, hey, there's a lot of borrowers that could be taking advantage of this and may have already be allowed to receive forgiveness on their loans based upon the amount of time that they've been paying them off. So they're reviewing all of their accounts, regardless if you're in an IDR plan or not, to let borrowers know, hey, like you could receive forgiveness here. We've done this adjustment now, and we're applying it to all of our Department of Ed loan borrowers. So a little more about fast facts here about who this adjustment actually is for. It's for folks who are currently in an income-driven repayment plan, maybe, or they were one in the past and now they're not. Perhaps we have folks in the public service loan forgiveness program, such as myself and most of my colleagues on the line. Or even, again, like I mentioned, folks who are not in an income-driven repayment plan, but maybe they're interested and they have Department of Ed held loans, meaning they have direct loans or FFELT loans. Again, they have to be held by the Department of Education, right? They're going to review those accounts and let borrowers know, hey, you could be eligible if you want to for forgiveness. Here's your option. You can say yes or no. Of course, you have that option. Any borrowers with loans that have accumulated eligible time in repayment over the last 20 or 25 years, depending on the specific borrower situation, will be able to receive automatic forgiveness. Again, this is even for folks not even enrolled in a plan. So how's this all going to work? So the Department of Ed has been reviewing all borrower accounts, again, with at least one loan held by the Department of Education here. And they are identifying all payments to be counted and instruct their loan servicers to make those adjustments and those updates to your account. So again, the Department of Ed has been reviewing loans that have been in repayment long enough to receive the IDR forgiveness, and they would then qualify. They're also reviewing borrowers with at least one approved public service loan forgiveness form to update their monthly counts that can potentially lead them to be closer to that 120 count for PSLF only. And the Department of Ed is also reviewing all eligible loans to update the months that would then just qualify for IDR forgiveness. Again, even if they're not at forgiveness quite yet, they're not at that 20 or 25-year period, perhaps they can get some additional years that are counting if for whatever reason there was some kind of miscalculation or whatever. So what loans are going to be eligible for the adjustment here? Qualifying loans are you seeing here on your screen? Really, they are direct loans and then FFELT loans held by the Department of Education. So this includes subsidized, unsubsidized, plus loans, consolidated loans already, of course, and then parent plus loans as well. So really, the adjustment is really all about if you have a loan that's not held by the Department of Education, meaning you have a commercially held FFEL, Perkins, or HEAL loan, you have to consolidate that into a direct consolidation loan, meaning it's going to be held by the Department of Education by April 30th of 2024. So we've been hosting a lot of these webinars trying to spread the word. I realize that deadline is tomorrow, but you can complete an application prior to then, right? By today or tomorrow. If you do need to consolidate, take advantage of this, this typically is for some of maybe our more experienced or older borrowers. There's that deadline of April 30th. If you have any sort of commercially held loans, FFEL, Perkins, or HEAL, consolidating by that date allows you to take advantage of the adjustment. So the payment account adjustment here, it's going to include any months in repayment status. Again, this is regardless of payments made, the loan type, or the repayment plan. We'll also include 12 or more months of consecutive forbearance or 36 or more months of cumulative forbearance. Any months spent in economic hardship or military deferments in the year 2013 or later. Any months spent in deferment except for in-school deferment in that same year prior to 2013. Or any time of repayment, deferment, forbearance, if applicable, on earlier loans before consolidation of those loans into a consolidated loan. Right, so consolidating your loan from those commercially held loans into a Department of Ed direct consolidated loan, they're going to count all of those time and repayments when you had it as a commercial loan. That's the big adjustment here, bringing you towards forgiveness, assuming, again, you consolidate by April 30th tomorrow. So our borrowers with multiple held loans can reach that forgiveness threshold at different times even. They may have one or more of their loans already forgiven, but they may still have a balance on the studentaid.gov website as well as their loan servicer site more specifically here. So it can take several weeks for this to kind of update on their sort of platforms here after this kind of passes here with the deadline and after their systems can get updated here, you will see a more accurate reflection, of course, of the adjustment taking place. Let's dive into some public service loan forgiveness details as well as consolidated loans. So just kind of a brief overview of what this program is for some of us on the call, maybe not familiar. This is a program that forgives the remaining balance on direct loans after making 120 qualifying payments under a qualifying repayment plan while working full-time for a qualifying employer. This only applies to periods of repayment after October of 2007 because that's when the program began. So here is some general, just a lot of information here on eligibility and then the application process. So I'm going to start with eligibility. Talked about having eligible direct loans. Talked about being employed full-time by a qualifying employer. Well, who are those people? This would be any federal, state, local, or tribal government, any 501c3 nonprofit. Common examples would be public educators, people who work in public library services, or another nonprofit organization that provides services to the public in some way. So there are plenty of nonprofit organizations out there who are not 501c3s, but they do serve the public. I know there's been some like hospitals that we've worked with in the past for borrowers that have had that count. So even if you do have a nonprofit organization, it's not a 501c3, but you believe it qualifies, apply, right? Make sure it gets in there. They'll double check and correspond with that employer to ensure that that is the case. And then, of course, they would get back to you. And then you have to make 120 qualifying payments, right? Full amount due, right? They can't be partial payments there in that sense. And then it have to be under a qualifying repayment plan, which would be either an income-driven repayment plan or the standard repayment plan. Now, when we talk to folks about PSLF, we recommend get into an income-driven repayment plan as soon as possible. Why? Because the standard repayment plan is designed for you to pay off your loans in 10 years, which is 120 payments. So you don't want to stay in a standard repayment plan for long because if you wait and 10 years goes by, there's nothing for the PSLF program to forgive because you would have paid off your loans. So ideally, you get into an income-driven repayment plan as soon as possible, which should hopefully, depending on your situation, decrease your monthly payment, allowing for a balance to be forgiven after 10 years of payments. So how do you apply? There is a PSLF application help tool on the PSLF portion of the studentaid.gov site, which is linked below. And once that application's been signed and submitted, the loans will then transfer to the PSLF servicer. Currently, this is Mohila, but that is actually going to be changing quite soon, and it'll be solely on the studentaid.gov site handling this. But for now, at least for my loans, I still have Mohila as my place, but I know that's going through a change. After making 120 qualifying payments for public service loan forgiveness, those approved borrowers will then be notified and say, hey, great, you've got this balance. The rest of it is forgiven. So how does this now connect with the payment account adjustment we're talking about here with that April 30th deadline? So the Department of Education started making these automatic payment account adjustments for PSLF back in sort of the end portion of 2023. Again, these were only for our borrowers, though, with eligible direct loans already. Borrowers who consolidate will have their payment counts temporarily reset to zero, at least on when they log into their servicer and they see that number. But those are going to be adjusted, right? And they've been doing so each month until those IDR plans they count for all federally held fell and direct loans in late 2024. And that's going to include those consolidated by that April 30th deadline here. So it may temporarily see it as zero, but that won't actually be reflected of accurate data. So you want to use that PSLF help tool to certify those periods of employment, as well as to track your progress. I do this every so often here. They recommend once a year going into that help tool to recertify information on your IDR plan, like we talked about earlier, and then getting an updated payment count about where I am in the PSLF process. After this adjustment in 2024 here, that July 1, all those periods credited towards IDR will then, of course, also be credited towards their PSLF accounts and their plans. Credits on consolidated loans. So under the current PSLF rules, if you consolidate, the qualifying payments made on your new loan will be credited using an average weighted of those payments. In the past, that wasn't the case. When you decided to consolidate for PSLF, they kind of shut it off and you had to restart back at zero. Under new rules, that's not the case. They're not taking an average of those prior payments. So a little bit of an example here to put it into context because it'd be a little bit easier to understand. For example, maybe you as a borrower, you have 60 qualifying payments already, and you decide to consolidate your loan now to make it an eligible direct consolidation loan. And on that other loan, maybe you had 0 qualifying payments. So now you have a new qualifying payment account of 30 payments credited towards PSLF with that new direct consolidated loan. For a limited time, the Department of Ed is also allowing qualifying payments from all loans, which would include commercially or federally held FFELP loans, to count towards their PSLF plans under that payment account adjustment, using, again, that weighted average example we talked about at that bullet point above. Again, this is assuming, though, that these borrowers apply to consolidate those commercially held loans by tomorrow, April 30th. A little bit about joint consolidated loans. The Department of Ed has been developing a process for loan separation to allow borrowers with joint consolidated loans who are trying to separate, maybe they've got divorced for whatever reason, to take advantage of PSLF and the account adjustment here. This is not going to be fully implemented, though, until late 2024 here. So borrowers are going to have to complete an application in a brand new master promissory note. They can file this application together, or it could be separate depending upon the situation of the couple. The joint application requires each applicant to request that loan separation of that joint debt on that same piece of paper. The separate one only allows one borrower would be then needed to request that loan separation, and it just applies to their portion of the debt. So for our folks who are in joint consolidated loans, they're encouraged to contact Federal Student Aid in the Ombudsman group or their loan servicer specifically to indicate, listen, we want to take advantage of this. We're interested in applying. We understand that the process is not going to be implemented till the late part of the year, but they're trying to gain information about these people as possible so it's on their radar and can follow up with that completed application once it is fully implemented. Okay, we'll now go ahead and dive in through some frequently asked questions and answers about all of this sort of IDR adjustment stuff. So, do I have to consolidate by the end of April 2024? Yes, you do. If you have commercially held loans, right? Loans that are not held by the Department of Education. This would be family federal education loans here, Perkins loans, or the HEAL loans. Have to consolidate by April 30th, 2024 to benefit for the adjustment. So you have about a day or so to get on studentaid.gov site in the consolidation piece and apply for that direct consolidation loan. How do I qualify for a refund? This kind of can sometimes happens to a couple of some borrowers out there. If borrowers made qualifying payments that exceed the applicable forgiveness period, they can maybe receive a refund for any sort of overpayment. So this is only applying for payments that were paid on the loan that is already forgiven. Payments made on a loan that is included in a consolidation loan would not be refunded. So if you have already received forgiveness, you've already paid off your loans, you're not going to receive any kind of payback, you're not eligible for a refund or anything like that. This, again, is just including payments made before loan consolidation. The refunds really only apply for payments of more than 20 or 25 years, depending on your plan, that were paid on the loan that was already forgiven. That's the situation where you can, of course, receive a refund from the Department of Ed. How will loan forgiveness impact my taxes? This is a common question we have received in the field. Federal government's not going to tax loan forgiveness, so that's a good thing. However, depending on your state, they might consider it taxable. Now, I'm assuming a lot of us on the call here are from the state of Illinois, given that we are a state agency in this state of Illinois. They do not tax forgiveness on loans as well. So that's another good thing. But other states might. I remember some talk, maybe I think Indiana might be a state that taxes loan forgiveness. Other states may do this as well. But the federal government's not taxing loan forgiveness, and neither is the state of Illinois. Any debt forgiven because of the payment count adjustment won't create a federal tax liability for loans discharged between December 31st of 2020 and January 1st of 2026. Department of Eds also will notify you if they plan on discharging your loans due to that payment count adjustment. We'll also provide you with a 30-day period to opt out of automatic forgiveness if you choose to do so. Again, here in our state, I don't see why you would. However, in other states, this could be a concern, and then they, of course, would give them the 30-day option to opt out of that automatic forgiveness. What if I have a Parent Plus loan? So Ed will forgive all Parent Plus loans, consolidated or not, again, assuming they have accumulated 25 years worth of time in repayment. This also includes borrowers under the PSLF program, during which, of course, that borrower was employed by a qualifying employer. So if you're on the call, you're a borrower, you have a Parent Plus loan, you don't reach forgiveness either through the income driven repayment plan adjustment or PSLF, then, of course, you need to consolidate that Parent Plus loan by the April 30th deadline that we've been talking about, and keep making payments under your income contingent repayment plan after consolidating to continue making progress closer towards forgiveness. What if my loans are in default? So borrowers with defaulted loans can get the benefits of this payment account adjustment by just getting out of default, which would also include the Fresh Start program. So this was kind of passed a while back. It's a one-time pandemic-related opportunity that provided our defaulted borrowers with some benefits that would, of course, include them getting out of default. It would restore their benefits on being able to access different types of those affordable repayment plans, like all of the income-driven repayment plans we've talked about, as well as loan forgiveness programs like teacher loan forgiveness, public service loan forgiveness. And one of the biggest ones is that it includes getting rid of that negative credit reporting aspect of it, which is huge. I know that it affects a lot of our borrowers across our state and across the country. I've talked to some folks where it's negatively impacted their credit scores, and having Fresh Start and taking advantage of this and having that negative impact of your credit score wiped out is huge. While, of course, regaining access to all of the sort of flexibility benefits of having a Department of Ed held loan in the first place. So our defaulted borrowers here to take advantage of Fresh Start. Again, that deadline is September 30th of this year, 2024. So still have some time for our defaulted borrowers to take advantage of Fresh Start. Highly recommend, if you or you know anyone who are in default, to please go to studentaid.gov, check out the Fresh Start program, and have them take advantage of it. What if I have a joint consolidation loan and I can't split this loan before the April 30th IDR adjustment deadline? So the Department of Ed is going to provide the same payment count adjustment treatment to any borrower who eventually splits a joint consolidation loan by, of course, consolidating into a direct consolidation loan for themselves. Again, even if such split occurs after the date of payment count adjustment 2024, this benefit for these joint consolidated borrowers is going to be applied retroactively. Again, the application for this and the full implement of this program is not going to be ready till the end of this year, most likely. So this is why they're kind of giving these folks a break to say, don't worry, once this happens, you are interested in getting a split, the benefit that is taking place prior to April 30th will be applied to these folks retroactively. All right, so there's everything there about IDR and a lot of loan jargon. Let's go ahead and talk about some general resources for all of us to be aware of. I want to go ahead and highlight the current Department of Ed held loan servicers here. This has sort of shrunk a little bit over previous years. So if we have Ed Financial, Mohila, which is the current PSLF servicer, I will say that is going away. Mohila is not going to be the designated one much longer. Studentaid.gov is going to be the central location for those PSLF folks, but as of today, that is the case. Advantage, Nelnet, the ESCI, and also the Default Resolution Group. These are your loan servicer options here. If you don't know who your loan servicer is, best way is just to log into your studentaid.gov account, click on Manage Loans, and you'll see how much debt you have, how many loans you have, what kind of loans you have, and then more specifically here, who is your loan servicer. Here's an example of what their website might look like. Just to know that, like, once you figure that out, you're going to want to go to their website, create an account, because that's where you're going to be directing payments to every single month. And they're going to have the most specific and detailed information about your student loans. This is Mohila's site. This is my loan servicer, so that's who I chose to kind of screenshot here for you all. And you can see here right away on their homepage here, I have that option to log in right away or register and create an account if for whatever reason I hadn't done so already. Perhaps I just found out that Mohila was my servicer. So that's where you would go to log in. There's their page, and there's where I would, of course, access all of my details regarding my student debt. So here's a little bit more in terms of a screenshot on the Department of Ed site, studentaid.gov, about where to find your loan servicer. So you would log in on the top right-hand portion of your screen, and then you would go to that managed loans section here. Loans and grants is a fine spot to go to, and you would see managed loans right there under that subheading. And then when you click on that, it would give you the full details. Talked about this a little bit earlier in the presentation. This might be one of my favorite tools that studentaid.gov has to offer, and it's the Federal Student Aid Loan Simulator tool, right? When I talk with folks, it doesn't matter what age they are, they're out of school, they have debt, and they have questions about, changing their plans or trying to see if they want to go back to school and they want to borrow more and how that's going to affect their finances and their monthly payments going forward. I turn them here, right? Gives them these options and it walks them through all the different steps about simulating these different types of situations. First one on your left, you're seeing is I want to find that best loan repayment strategy, right? Depending on what you want to do. Maybe you're a borrower who wants to pay off their loans as quick as possible, right? You can maybe afford a higher monthly payment. You're trying to cut into that interest rate as best you can. It'll simulate that for you and give you a plan that best meets your needs. Or maybe you're like me. I'm trying to get loans forgiven through a specific program. I want my monthly payment to be as low as humanly possible. I don't really care about the interest necessarily because whenever that 10-year period goes up, that balance could be as high as it wants, and I'm trying to get that forgiven. So I'm trying to maximize the amount of balance after 10 years to get it forgiven, allowing my monthly payment to be as low as possible. Really just all depends, again, on your situation and what your goal is with student loans. It can also help you decide if you need to consolidate your loans either. It will give you the pros and cons of doing so for each. Great place I take folks. Maybe you are already in the process, right? You're paying off your loans and your monthly payment's getting a little too high. You're struggling. Maybe something's going on. You need to postpone some payments, temporarily make smaller payments. You can go here and kind of simulate those situations as well. Perhaps this means you are applying for a brand new income-driven repayment plan. The new SAVE plan that the Biden administration has implemented, a lot of borrowers have taken advantage of that. It really has kind of cracked down on capitalized interest for borrowers, which has helped monthly payments for borrowers across the country. So you can take a look at that, see if there's a different IDR plan that works for you, or you can maybe look and apply and read more about deferment and forbearance options, finding out how suspending payments impacts your situation. And then, of course, more importantly, learning how to avoid default. We talk about all the negative impacts of default a little bit earlier here, and it goes through those types of things with you. Or if you have different students who want to simulate more borrowing, right? They got debt, but they want to go and get a master's degree, or they want to get another certificate at a community college. How would taking on $10,000 more of student debt impact your borrowing, how much more longer you'd be paying off this debt, and your monthly payment? So you can go through all of those options in that right portion as well. Great tool to use for yourselves and any of your friends who have questions. Want to highlight our ISAG resource page here, where we have specific guidance and just some general information about the one-time payment account adjustment. We also have a lot of resource links back to the Department of Ed site, similarly to all these slides that I've showed you today, as well as some other forgiveness programs for you to be aware of, like public service loan forgiveness. This is actually our last webinar that we are hosting about the topic because the deadline to consolidate, take advantage of it, is tomorrow. So we had some throughout the month of April. You're seeing the last couple of dates there on your screen here. We had one back on April 24th, and then obviously we are here April 29th today. This is our last session, but again, we're going to have this recorded, posted on our website, like I mentioned earlier, on the on-demand page. You need to go refer back to this. Some of our other ones are just as up to date. The information really hasn't changed. Feel free to review those, get the right information, and apply to consolidate by that April 30th deadline. Submitting a complaint to the Department of Ed. I'm sure all of us have wonderful things to say, obviously, but we have a spot to view here. If for whatever reason you need to submit a complaint about something that's going on with your account, right? The Department of Ed needs to know if there's an error to reach out to submit that complaint, and hopefully they can get that issue resolved. With some of the issues regarding the new FAFSA, we have also had folks come here as well to let the Department of Ed know so that they can hopefully update their key issues alert page as well. Again, they ain't going to be able to make an adjustment or a correction for anything if they don't know about it. So they've given a platform here to submit a complaint. And also, if there's any sort of other suspicious activities or scams that you think you may be encountering, this is the spot to go to submit that complaint. Also, want to be aware of scammers. Don't trust anyone who tries to contact you with the promise of debt relief or forgiveness. Scammers do a really good job as trying to look real with specific lettering, legitimate logos and names, and the way they organize things. And make sure you're being highly aware of that with all of the sort of hot topic news regarding loans, student debt in the news. Scammers are on the rise. How to spot them? Again, avoid paying for help if you can receive it for free. Most folks who are trying to charge you for the promise of relief and debt forgiveness, that doesn't make any sense when you can receive all that information for free. So that's one kind of tidbit there. Anyone asking, again, any kind of upfront cost or a monthly fee over time, or anyone promising immediate loan forgiveness. That's not the case, right? There's all these programs out. It takes time. There's specific eligibility criteria to receive forgiveness. Someone just offering you forgiveness straight up for whatever reason is not accurate. Or more importantly, anyone asking you to provide your FSA ID login information. Do not share your FSA ID, username, password with anybody. Lots of sensitive information there, lots of PII. Make sure you do not share that with anybody. Okay, so my colleague on the line is going to open up the chat for all of us now to provide the evaluation link from you. Again, we are not offering CE and PD hours for the session, but we would so love to hear from you. And providing your feedback for today's session can be done by clicking on that link and completing the survey. We will have this link open until 11:59 p.m. on Wednesday, May 1st. Typically, we try to give 48 hours, give or take, for all of our evaluations. So that will be there. The link is just posted in the chat feature, bottom right-hand corner of your screen. It looks like a little iMessage bubble. Click on that. You'll be able to get the evaluation there. And with that, we hope this information was valuable and useful to you. Thank you for joining us for our IDR Countdown webinar series. Again, the deadline is tomorrow, April 30th. If you haven't applied to consolidate and you need to, if you have any of those commercially held loans, please do so by tomorrow to take advantage of it. If you have questions throughout your student loan borrowing process, you know where to find us at the ISAC Borrower Support email address, and we'd be happy to assist you in any way we can. Thank you so much for joining. Hope you all have a great rest of your day. Take care.